What is good, Stackers University? I'm not going to say I did anything wrong, but getting this beauty for 4% over spot feels like a steal. Regardless, criminal behavior is nothing new, as humans have always blurred the line between law and chaos. Criminal behavior can encompass a wide range of activities, from minor offenses to serious, but broadly speaking, criminal behavior is defined as actions that are generally deemed harmful or disruptive to individuals, communities, or the function of the society as a whole. This is why we have laws. While there are many laws that make sense, there are countless examples that make you go, huh? For example, did you know that in Alabama it's against the law to wear a fake mustache that causes people to laugh in church? Or in Texas, criminals are supposed to give their victims 24 hours notice of the crime they plan to commit. Who said Texans aren't thoughtful? And in Maine, they made it illegal to have your Christmas lights up past January 14th. I just want to know why the 14th, not the 13th or the 15th, but regardless. While I didn't mean to be overly dramatic or sensational with my use of the phrase, it's simply criminal, I just don't know another way to express how shocked I was when I saw a chart of asset allocation by professional financial advisors. I mean, these people are supposed to be some of the smartest people when it comes to managing someone else's money. But I guess that's why Robert Kiyosaki makes the joke that they're called brokers, because they're usually broker than you. That aside, as this chart from Crescat Capital shows, all we've heard about for the last 40 years has been this 60% equities and 40% bond asset allocation. Don't get me wrong, the performance has been very good, as this chart shows. But what happens if we measure that 60-40 allocation against gold since we entered the 2000s? Well, Bob Elliott posted this on Twitter at the end of October, and would you look at that? This barbarous relic, that pet rock, has significantly outperformed the 60-40 portfolio. Yet these quote-unquote smart money managers simply ignore gold and silver. But why? Well, in my opinion, it's because they couldn't make money off of you if you bought physical gold and silver. And they definitely didn't want you diverting cash from your account into something they couldn't make a management fee off of. Even with the advent of the first gold ETF in 2003, money managers and big firms just couldn't bring themselves to purchase a real asset like gold and silver when the financial assets was where all the action was. Fast forward to today, and the numbers are simply shocking. Take a look at this chart from Bank of America's Wealth Management Marketing Research Report. 71% of financial advisors have 0 to less than 1% allocation to gold, while 27% have 1 to 5% in gold, and only 2% have an allocation of 5 to 10%. We've covered this in previous videos, but the research shows that the optimal allocation in gold and silver for maximum returns is 25%. This is absolutely insane to see how little is allocated to an asset class that has actually performed on par or better than the 60-40 portfolio over the last 20 years. This is why I say it's simply criminal. This is why each of us has to get our hands on physical metals. Because apparently the smart money advisors, they really ain't that smart. In fact, as we all continue to see an environment where we need as much gold and silver as we can get our hands on, we continue to see outflows from gold ETFs here in the US and in Europe, but not in Asia. As this chart shows, Asia continues to have money flow into these ETFs. Meanwhile, as you can see from this chart, since 1970, gold has been doing its, DJ Khaled, all I do is win. Some of y'all might have to Google that to get that later on. But anyway, yet somehow 71% of advisors have less than 1% allocation to gold. Well, we all know gold does well during inflationary times, but let's take another look at this performance. This looks like gold does well all the time. It just does exceptionally well during high inflation. I know some of you are going to say, well, look at the 80s and the 90s. Well, that was also because we were at the beginning of our QE experiment, what ultimately led to a zero interest rate environment, which is why we are where we are right now. Where are we? Well, we know a recession is inevitable, though it may not be imminent, which is great in my eyes because, as this chart shows, 6 months prior to and during a recession, nothing comes close to gold's performance. You know who else understands this? Central banks. They know that they need to diversify their financial holdings. They know they need to get away from the dollar. And I'm certain they know we are shifting from financial asset world to a real asset world. We know they know something because look at how they've been buying gold. Look at the light blue bars over the last 5 years. Now also notice those yellow bars, which are investment ETFs, as they go negative in 2021 and 22. Meanwhile, this chart shows you how bullish Americans have become towards gold. This is further reinforced by this chart where 60% of the people believe real estate and gold are the best long-term investments. It seems to me that the smart investors and central banks have already started to realize that a major shift is about to occur, and owning gold and silver are a major part of their plan. Meanwhile, these financial advisors continue to flee from metals and their ETFs. I say this all the time. Too many people wait for price confirmation before they act. You can't wait for the hockey puck to stop and then skate over. You have to skate to where it's going to be. This is what the data is telling us. It's trying to let us know and trying to show us where the puck will be. Look at this commodities to equities ratio chart again. Now listen, do you hear it whispering to those that are willing to listen? I guess these so-called advisors are simply going to wait for the whispers to turn to screams before they do anything. As frustrating as it is, this is still great news for us. And I'm going to continue to beat these drums with these two messages. One, because we are early, it's going to feel like we are wrong. We are not. We are simply skating to where the puck is going to be. And two, being early only gives us more time to accumulate and wait. Once these so-called advisors and general public wake up and realize where the puck is, they will rush over to chase it down. And in investing, you never want to be chasing. You want the crowd to be rushing in as you're starting to look for an exit. The other day, I heard good old Rick Rule say something profound about the uranium market. He said, the easy money has been made. The real money gets made now, and the big money gets made when it gets stupid. Right now, all we need to do is focus on making the easy money. Stacking silver for cheap at below $25 an ounce with the premium included, and gold for around $2,000. Because my suspicion is that once gold breaks through $2,100, prices and premiums will shoot up because too many people are waiting for price confirmation before they start buying. This includes getting your mining stocks. I know some of them look bad as the miners keep getting beat down, but this is the time when you want to build your positions. When there is risk in the financial system, when no one else is invested in it, and no one else even wants it. While people keep foolishly thinking that a portfolio is a 60-40 split of equities and bonds with zero metals. Given the data, the market conditions, and the trend, gold and silver's underallocation is damn near criminal in my eyes. Again, as I just mentioned, this is while gold is approaching its all-time highs. And even at its almost all-time highs, the ratio of a price of ounce of gold to the S&P is right around 0.5, while the average is 1.67, which means between the S&P going down and gold going up, there's a 3x move in there from today. One last chart, folks, and this one is from Tavi Costa, and if you're on Twitter, you really need to be following him. This chart is amazing. Here he compares Apple and Microsoft as their own sector against the material sector, energy sector, and finally the metals and mining industry. Metals and mining make up just 0.2% of the S&P index weighting. You want to know why our mining stocks are beaten down like they are, like nothing else you've seen? There's your answer. It's 70 times less weighting than Apple and Microsoft alone. That whole sector. And that's insane. And it should be criminal. I also need to point out that 0.2% weighting is all mining metals, not just gold and silver. While gold and silver continue to be underowned by both retail and institutional investors, the period of low inflation and decent economic growth where these metals were not needed, that's actually behind us. I know it's not coming fast enough, but that's the gift we are being given. So if what these financial advisors are doing is criminal, it has to be insane if you aren't doing everything in your power to get out of debt, tighten up your spending, and deploy as much as you can into gold and silver, even if it's 190% silver dime at a time. In the comments, given the historical performance, why are gold and silver so unloved by the mainstream? What will finally cause the general public to shift into metals? A financial crisis? Gold reaching its all-time highs? Am I being overly bullish about metals? Or you can simply put an A+ in the comment section so that everyone knows that you always stack smarter and never stop learning.